Everybody, this is week 5 and this is lecture 1, Monday 15th of November. Okay, this is topic 4. So in topic 4 you will learn about adjustments, and then after that you will you have to do topic 5, which is preparation of financial statement for sole proprietorship. So I combined the lecture notes because topic 4 and topic 5 is like continuing, and then topic 4 and topic 5 also topics that explains about accounting process. Okay, that's it. So remember, when you now you are learning accounting process or the way to do accounting record for a business. So just to refresh your memory, when you want to make accounting record for a business, you have to follow accounting cycle. So the first step in the account, there are 8 steps in the accounting cycle. The first step is doing analysis. The second step is doing journal. The third step is preparing the ledger. And the fourth step is preparing a trial balance. These 4 steps have been covered in topic 3. And now in topic 4 and 5, you will learn about topic 5. You will learn about the step 5. Step 5 is doing adjusting entries. After that, you will learn about preparing an adjusted trial balance, and after that you will learn about in topic 7 you will learn about how to prepare financial statement, and the last step in the accounting cycle, which is step 8, is doing closing entries. So now you are in step 5 of the accounting cycle, which is doing the adjusting entries. Before you learn about how to do adjusting entries, you need to know several things related to that step. So the first thing that you have to know is periodic reporting. I hope you still remember, in topic 1 or topic 2 you have learned about accounting assumption. One of the assumption that we have is time period assumption or principle. Time period assumption says when you do accounting record, you have to assume that the life of a business can be divided into into periods. Okay. When you do accounting record, firstly you have to assume that the business will continue to operate in the future, and the second thing is related to this time period assumption. You have to assume that the life of the business can be divided into periods. So most of the time, see here the first point in this slide, most of the time businesses, they divide the life of the business into 1 year. So all businesses, I can say all businesses, they close their account every year. So when they assume that the life of the business can be divided into yearly, so every year they close their account for the purpose of calculate the profit for the year. It is also required by law and regulation. I think in all countries, every year a business has to close its account to calculate profit and then to pay tax. So fiscal year, see the first one there, fiscal year, a 12-month accounting period. So every business, they have to close their account at least once a year, at least every 12 months. They have to close the account, calculate profit, and if they have to pay tax. So if the business is started in 1st of January, then the business has to close account at 31st of December. But if let's say the business is started at 1st of April, then the business has to close its account 31st of March the next year. So it must be a 1 year period. But if you have a business, you can close accounts every month. That is for your own purpose. You want to know every month how much the business makes profit, so you close the account every month. Or some businesses, I have seen several. I have seen businesses that close their account every 3 months. Every 3 months, they will prepare income statement and balance sheet because they want to know the profit every 3 months. Some businesses every 6 months, but all businesses are compulsory according to law and regulation to close their account at least once a year. Okay, that's it. Fiscal year is the accounting year. Calendar year is the calendar year, the year according to the calendar. According to our calendar, the year is started with 1st of January and ended at 31st of December. But fiscal year can be any time during the year. If a business started its operation on 1st of February, then the business has to close its account 31st of January next year. That is one fiscal year for the business. Okay. Okay, so the second thing that you have to know before you can learn about adjusting entry is just you have to aware that in accounting we have two bases, accrual basis accounting and cash basis accounting. Okay, let's see. So this one, accrual accounting. So okay, look at accrual accounting first. Accrual accounting is the type of accounting that a business has to use when the business make accounting record. So the situation is like this. Let's say you have a business. According to law and regulation, you have to do accounting record for the business using accrual accounting. That's what happened in Malaysia and many other countries. Okay, accrual accounting. Okay, let's see what is accrual accounting. What do we do when transactions span more than one period? Okay, the accrual basis accounting is crucial or important when a business transaction happen, but the transaction involves more than one accounting period. Okay, for example like this. Let's say you have a business, and then your business started at 1st of January, and the accounting period will end at 31st of December. Let's say one transaction happened. The transaction is like this. At 29th of December, you pay something. At 29th of December, you have received let's say electricity bill for the month of December, $300. You receive the bill, but you will pay the electricity bill next month or next year. You will pay on the 5th of January. Okay, this transaction involves two accounting period, this year and the next year. So when this kind of thing happen, You have to understand accrual accounting before you can do the recording. Okay, let's see. Accrual accounting. See the green title there. Accrual accounting. Revenues and expenses are recorded as they earn and incurred, not necessarily when cash is received or paid. So that is the main point. Accrual accounting says you record revenue when the transaction happen, not when you receive cash from customer. And also, you record expenses when the transaction happen, not when you pay the expenses. Like the example that I made earlier, you receive an electricity bill, $300 on the 29th of December, but you will pay on the 5th of January. So the way to do the recording for this electricity expense is to record the expense on the month on the 29th of December, because it happened on that time. You cannot record the transaction on the 5th of January. No, that is the time you pay, but the expense happened in the month of December, so you have to record it at the on the month in the month of December. That is the basic idea. Later you will see how to apply this accrual accounting. Okay, accrual accounting is a better measures of firm performance than do cash flow data. Okay, I will. There is an example for that in later slides. You will see about that one in the later slides. Okay, this is another thing that you have to know. Revenue recognition principle. Revenue recognition principle also related to accrual accounting. In a simple way, it says that revenue recognition principle says that when you want to record revenue, you have to record it when the transaction happen, not when you receive cash from customer. Okay, let's say you have a business, your business will close its account at 31st of December. At 30th of December, a customer come. You provide service to this customer and you charge this customer $50. But the customer says he will pay later, next month, he said. So, if that is the situation, the question is, when is the time to record the $50 revenue? Okay, the answer is on the 30th of December. That is when the service has been provided or things that has been sold on that day. The transaction happened on that day, you record the revenue on that day, not when you receive cash from customer next month. Okay, so that is the revenue recognition principle says. If you look at the detail, this is the detail. You record revenue or recognize revenue when there are two criteria. First, the earning process is substantially complete. The second criteria is cash has either been collected or collection is reasonably assured. So this is the criteria. So in short, just remember this. In accounting, you record the revenue when the transaction happen. Okay, question arises. How to know the transaction happen? The transaction happen if a business or a seller transfer the product to the buyer, or if a business has provided services to a customer. So in accounting, revenue transaction happen when goods are changing hand, from the hand of the seller to the hand of the buyer. So if you have a business, then you want to record revenue, always remember you record revenue when it happened, when the transaction happened, or when items or things has changed hand from the hand of the seller to the hand of the buyer. Or if you have a service business, you record the revenue when you have provided services to a customer. Even though the customer has not paid yet, you record the revenue when the service transaction happened, not when you receive cash from the customer. Okay, remember that. Okay, another thing that you have to know before you can do adjusted entries is the matching principle. Okay, matching principle. Remember this. You have seen this principle in topic 1 or topic 2 when I discuss about accounting assumptions. Okay, just to refresh your memory. So the matching principle says, in short, it says that if you want to calculate profit for one accounting period, you have to match the revenue of that period with expenses for that period only. So the example is like this. Let's say you have a business. You want to calculate profit for the year of 2021. The thing that you have to do is you calculate revenue for the year 2021, and then you minus expenses for the year 2021 only. Then you will get profit for the year 2021. You cannot add revenue from year 2020 or revenue from year 2022. Also, you cannot add expenses from the year 2020 or expenses from the year 2022. Remember that. Okay, this is an example that shows the difference between accrual basis accounting and cash basis accounting. Okay, remember this. Okay, let's see the example first. In year 2019, Bond Consulting billed its client for 48,000. So Bond Consulting is a service business. For a service business, after the business provide services to a customer, the business will send bill to the customer. So the customer knows, oh, he has to pay the bill. So this is the thing that happened. Bond Consulting has provided services to customers and send bills to clients, and the value of the bills is 48,000. On December 31st, 2019, it has received $41,000 cash, with the remaining 7,000 to be received in 2020. Okay, from the 48,000 bills, the business only received $41,000 cash. So it means that the 7,000 still unpaid by the customer, the business clients, will be paid later by the clients. Total expenses during 2019 were 31,000, with 3,000 of this cost not yet paid at 31st of December. Okay, so let's see how or what is the difference if you calculate profit using accrual basis accounting and cash basis accounting. Okay, this here you see how to determine the net income or net profit using both methods. Okay, you have to know how to do this. Okay, let's see. If you use cash basis accounting, okay, this is the way to calculate the profit. If you use the cash basis accounting, revenue equal to cash received by the customer. revenue equal to cash received by the business from selling things or providing services. So for this business, see, for bond consulting, the cash received from clients is 41,000. That is revenue according to accrual basis accounting. But for if you use accrual basis accounting to calculate profit, according to accrual basis accounting, revenues equal to services that have been provided, or things that has been sold, or things that had happened during the year. So in this situation, in this example, according to accrual basis accounting, the revenues equal to 48,000, because that are the bills, that are the service that have been provided by the business, and also that amount have been written in the bill sent to clients. So 48,000 revenue according to accrual basis accounting. Cash basis accounting, revenue equal to 41,000 only, which is the cash received from customer or client. Okay, that is one thing. And then remember, to calculate profit, you have the basic formula is revenue minus expenses. So we have calculated the revenue. Now we calculate the expenses. Okay, using cash basis accounting. According to cash basis accounting, expenses are amount that has been paid by the business for expenses. So in this example, total expenses, see here, total expenses during 2019 were 31,000, with 3,000 of this cost not yet paid. So how much has been paid? How much has been paid? So the amount that has been paid is 28,000, which is 31,000 minus 3,000. So according to cash basis accounting, the expenses or cash disbursement equal to 28,000. But when you use accrual basis accounting, remember, when you use accrual basis accounting, expenses are recorded when they happen. So in the year 2019, total expenses that happened were 31,000. So see here, under the accrual basis accounting, total expenses 31,000. So you can see, now you can calculate the profit. Under cash basis accounting, the profit is 41,000 minus 28,000 equal to 13,000. Under accrual basis accounting, the revenue is, the profit is 48,000 minus 31,000, which is 17,000. So this is very important. You have to know how to calculate profit using cash basis accounting and accrual basis accounting. So now, another question arises. Which method shows the most accurate profit? Accrual basis accounting or cash basis accounting? Okay, the general answer for this is, the general answer for the question is this. Accrual basis accounting shows the more accurate profit. The reason is, this basis, the accrual basis accounting shows more accurate profit because this basis shows the things that happen in one accounting period. The revenues are revenues that happen during the accounting period. The expenses are things that happen in the accounting period. So the profit equal to things that happen in the accounting period. Cash basis accounting profit can be said as less accurate profit because it only shows cash in minus cash out. You can see in the example here, the profit is calculated by calculate the total cash received from revenue minus cash out because of paying expenses. That's all. Okay, now you have seen three points, three main very important points before you can learn about, or before you can do adjusting entries. I think the first one is time period assumption, and then revenue recognition principle, and then matching principle, and then the last thing is you compare the cash basis accounting and accrual basis accounting. So with that knowledge, now you can do adjusting entries. Okay, let's see. Adjusting entries. Adjusting entries are entries that are required at the end of each accounting period to adjust the accounts to their proper amounts. So, the main reason you do adjusting entries is to follow matching principle. Remember that. If there is a question asked you, why adjusting entries have to be done? The answer is, adjusting entries have to be done in order to follow matching principle. Matching principle says when you want to calculate profit for an accounting period, you have to match revenues of that period with expenses for that period only. Okay, so there are four main types of adjusting entries. The first one is unrecorded receivables. The second one is unrecorded liabilities. The third one is prepaid expenses. The fourth one is unearned revenues. Each adjusting entry involves at least one income statement account and one balance sheet account. Okay, income statement accounts are revenue accounts and expenses accounts. Balance sheet accounts are assets accounts, liabilities accounts, and accounts related to owner's equity. Okay, let's see the adjusting entries by one by one. Okay, let's see. These are the steps. When you want to do adjusting entries, you do these three steps. The first one, identify the original entries that were made, and then determine what the correct balances should be at this point in time. And in step 2, you have to know how to apply the matching principle and revenue recognition principle. Then you can do the step 2. Step 3, make the adjustments needed to correct the balances. It is not very difficult, but you have to see many examples before you get the logic. Okay, let's see. Okay, see, this is an example for adjusting entries for unrecorded receivables. Okay, let's see. Precision Management is a business. It earns rent revenue of $500 in year 2019, but will not receive the payment until January 10, 2020. An adjustment will be needed. Okay, the situation is like this. Precision Management is a business, and it closes its account at 31st of December. Remember, in accounting, business has to close its account at least once a year. So for this business, the business will close its account at 31st of December 2019. The thing that had happened is the business earns rent revenue $500. It means that the business has a building, and the building is rented by somebody. In December 2019, the building has been rented by somebody. But the person who rented the building will pay the rental in January 10, 2020. Okay, so now an adjustment will be needed. So remember, why you do adjustment? Because you have to follow matching principle. What matching principle says? Revenue for the year for this business, revenue for the year 2019 have to be matched with expenses for the year 2019 when the business want to calculate profit. So the question is, this $500 is revenue for year 2019 or year 2020? Okay, that is the first question that you have to ask. The $500 here is revenue for year 2019 or year 2020? The business wants to close its account. Let's say you have to assume that today is 31st of December 2019. So when the business closes its account, the business has to decide, this 500 has to be recorded in year 2019 or 2020. So if I ask you, this $500 is revenue for year 2019 or 2020, then the answer is 2019. Why this revenue is for the year 2019? Because the rental happened in the year 2019. The revenue recognition principle says, in accounting, you record revenue when it happened. The rental happened in year 2019, so you have to record the revenue in year 2019. So, but you have to record the revenue in year 2019, but at 31st of December 2019, the business has not received the cash yet. So this is the way to do the adjusted entry. 31st of December 2019, first thing to do is the business has to record the revenue because it happened in year 2019. So remember, when you want to record the revenue, you have to remember the rule of debit and credit. Revenue increase, the business has to record the revenue. So revenue increase 500. How to record the increase in revenue? You have to credit the account. So that's why you see here, the adjusting entry is credit rent revenue 500. That's the first thing. And then what is the account that you have to debit? Okay, so you have to aware that the business will receive $500 cash next year, in year 2020. So that is an asset. If you have, in accounting, if you have a business, your business will receive something in the future, will get something in the future. That is asset. So the 500 that will be received in year 2020 is an asset. In accounting, we call it receivable. So for this adjusted entry, you have to debit account rent receivable. The account is for rent that the business will receive in the future. So asset increase, you have to debit. So that's why you debit account rent receivable 500. Okay, that is an example for unrecorded receivable. Okay, the second type of adjusting entries is unrecorded liabilities. Okay, see here, there is an example here. Protege Incorporated is assessed property taxes of $1,000 for year 2019, but will not make this payment until January 5th, 2020. An adjustment will be needed. Okay, you can see here the business is Protege Incorporated. The business close its account at 31st of December every year. So at 31st of December 2019, the business has closed its account. Has to close its account. The situation is, for the year 2019, the property taxes that the business has to pay is $1,000. But things for taxes is like this. Taxes for this year, you will pay it next year. So that's why this thing happened. The taxes is $1,000, but will be paid by the business next year at January 5th. So now, the account has to be closed at 31st of December 2019. So when the business closes its account at 31st of December 2019, the business has to decide about this $1,000. How to record this? Okay, when you want to do this, you have to decide. Taxes in accounting is an expense. So you have to decide when is the time to record the tax expense. In year 2019 or year 2020. So remember this. Again, in accounting, when you want to record an expense, you have to record the expense when the transaction happen, not when you pay cash for the expense. For these property taxes is for the year 2019. So it has to be recorded in year 2019. So that is the adjusting entry for this. You have to record the tax in the year 2019. So 31st of December 2019, you record the tax. According to the law of the rule of debit and credit, expense increase, you have to debit the account. So property tax is an expense. In accounting, it is an expense. So the business has to record the expense. So debit property tax expense $1,000. But the tax will be paid next year. So it is like the business will have to pay something in the future. So in accounting, if a business has to pay something in the future, it has to be recorded in as a liability. So liability increase, you have to credit the account. So that's why you see here, debit property tax expense $1,000, and then the business has to credit property tax payable $1,000. So the liability is recorded in a payable account. Payable means something that a business has to pay in the future, and this payable is for the property tax. So that's why the name of the account is property tax payable, credit $1,000. Okay. So I think I will stop here. You have seen two types of adjusting entries. In the next lecture, you will see another two more types of adjusting entries, and also there are two more other adjusting entries that you have to know. Thank you very much. Do not forget to write your name and matric number in this in the comment section of this video. I will take that as the lecture attendance.